Good afternoon, folks. Steve Charlton here, coming to you with another dose of financial wisdom. And today we're talking about the MOVE index. So the stock market's fear gauge is startlingly low, and that has become quite a bit worrisome for most investors. And here's why you may want to watch the bond market's fear measure instead. The VIX, popularly known as Wall Street's fear gauge, measures the implied volatility of the S&P 500 based on options that will expire over the next 30 days and is currently one of the best ways to assess the level of concern in the market. A low reading indicates tranquil markets, whereas a high one indicates investor panic. A few days ago, the VIX fell to 13.5, its lowest level since January 2020, months before a global pandemic would shut out economies across the world and spook financial markets. A VIX reading this low usually indicates extreme calm and often coincides with rising stock prices. And that tracks, powered by really only a small handful of tech stocks. The S&P 500 is currently being propped up really with those handful of stocks. But a very low VIX in and of itself can be a warning sign as well. It's what happens when investors become complacent and start to ignore downside risks. Many investors have been ignoring downside risk for the past 18 months, and it's hurt them greatly. And there's no shortage of risk these days, from the future direction of interest rates, inflation, to falling economic growth and growing strains within the banking system. Bond markets, in comparison, are extremely turbulent. And the Intercontinental Exchange MOVE, M-O-V-E, index of implied volatility, which is to the bonds what the VIX is to stocks, is currently flirting with levels typically associated with major crises. The index has come down from the highs it hit in March following the collapse of the Silicon Valley Bank, but it still remains 60% above its 10-year average. 60%. As always, what does this mean for you? Well, there's two things here for you to take away. Number one is that the bond market dwarfs the stock market significantly. And number two, well, keep in mind the old Wall Street saying that the bond market is always smarter than the stock market. If that's true, then you most likely want to exercise some serious caution right now. That is making sure that your portfolio is actually well diversified, meaning that if you lost money last year, you are not well diversified. Folks, the definition of diversification is mitigating risks and losses. And that's unfortunately become all too normal in this industry today. And that's because most investors, maybe they're not certain of how to do these things or what to do as a whole, often rely on the advice of other advisors that have set it and forget it mentality, a buy and hold strategy, which is not a strategy at all. If it were a strategy, then hedge fund managers and the wealthiest investors and billionaires and economists across the world would employ the same exact strategy, which they never have or will. Yet you are told to do just that. But this means that you're going to want to hold some cash, making sure things don't contain leverage because there are more than likely a lot of volatile days ahead. As always, our calendar remains open for a conversation. Make sure that you are positioned to benefit from this volatility and turmoil. Click the link below, start a 15-minute conversation with my team and I, and let's give you total control and create a lifetime of peace of mind for you, your spouse, and your legacy. Thanks for tuning in, folks. As always, have an incredible rest of your week, and God bless.